All right, so a very interesting week in the markets. We just had S&P very close to an all-time high. The all-time high was just above 6,400. We closed the week at 63.89. NASDAQ hit an all-time high, intraday high, and weekly high to close out the week. So the bull market appears to be back on. Technically, it depends how you look at it, because the growth side of the market had a very good week. The Mag 7 was up about 5.5%, S&P about 2.5%, the NASDAQ was up a little over 3%. Small caps and mid caps, not as much. They're only up, 50 to 100 basis points. So kind of an interesting week in that sense, that the growth side of the market absolutely dominated. In some ways that's concerning, and in other ways it's good. I want to talk about that. I want to talk about earnings. I want to talk about Bitcoin. First things first, if you get value out of the video, as always, please like, subscribe, comment, check out the links below. So, like I said with stocks, last week I was concerned, and I think other people were concerned, that we were going to see a pullback going forward. And just because the market was up this week doesn't mean it can't be down big again next week. That's certainly possible. But we also have to keep in mind that the path of least resistance typically is what has happened over the last couple of 2, 3, 4 months. And we've had a pretty clear, staircase higher over the last few months. So again, if I was to predict the next week, the next month, probably it's going to be up. But we also have to keep in mind that the market certainly is expensive where it's at right now. So my strategy is, as always, dollar cost average, and adjust the amount you dollar cost average based on how expensive the market is. And on top of that, I'm always buying stocks, individual stocks, no matter where the market is, because no matter how expensive the market is, there's always going to be areas of the market that are trading at a discount. So that's my strategy. So let's get into earnings here. It was a very good earnings week. I think we've had actually about 81% of companies have beat earnings so far. So I think that that's part of the reason why the markets are up. I also think that the fact that the Fed, I believe, is expected to cut 75 basis points before the end of the year now, which up until 2 or 3 weeks ago, it was like one cut was priced in, and then like a 50-50 chance of another cut. Now we're looking at almost certainly 2 cuts, possibly 3. So I think that that's part of the reason why the market is looking better this week. And I think that we didn't really get any major data to come out this week, so I think that played into it as well. So that's going to be interesting. But like I said, as far as my thoughts on the market going forward, we certainly are very expensive. Like that's undeniable. But I don't think we're like extreme, like tech bubble levels like some people are talking about. And I've said time and time again that, yeah, the PE ratio on the stock market is abnormally high. But you also have to look at the PEG ratio. The PEG ratio, I believe, shows we're around like 1.3, 1.4, which I believe the market average is about 1.1 and 1.2. So we're certainly overvalued. But fair value on the S&P right now is maybe 5% below where we're at right now, which again is nothing significant. Like that's not significant at all. That's not even correction. That's not even like anything that anyone would be concerned about. So I do think we're over. I like before the end of the year, I would be very surprised if we didn't have at least a 10% pullback at some point. But we also have to keep in mind that the S&P could go up to 7,000 before that happens, and correct down to 6,500 or 6,400 where we're at right now. And the people that said they're going to wait for a pullback are going to look stupid. Like that's probably more likely than the pullback happens next week or even the week after that. So that's my thoughts. Let's get into earnings here. Palantir was the biggest company, or the company this past week. They released very good earnings. However, we also have to keep in mind that the company was up 17%, which is just insane. So the question with Palantir is they're way too expensive, right? I mean, they have a PE of 577, a price of sales of 128. I mean, even their PEG ratio is 15.65, which again, I just said anything above 2 for me, I don't think I would buy no matter what. I wouldn't say 100% of the time, but anything above 2 is frothy. 1.5. Most likely I would buy it. So this company is worth, like, I would say maybe $30 a share, maybe 40 if you're being really optimistic, and it's about 186. I don't know if I've ever actually mentioned it, but I did buy a small position in Palantir back when it was like $15 a share. I sold it at like 30 or 40. Genius, and look at where we are right now. So again, that's something that a mistake that people make a lot. But I mean, in retrospect, a lot of that I did put into strategy, which was, that would have been probably a year or two ago. I don't remember now, but still, it worked out in the end. It just could have been better. But again, at the end of the day, for every one of those stocks that you sell at $30, a lot of those are going to go right back down again. So even though it was a mistake in hindsight, I think at the end of the day, it was the wrong decision. The next one is ALSN, which again, I think this is a solid company. I'm not buying it right now, but I do think it's a solid company. Beat earnings and revenue. They were down slightly on the week. This is a more popular one out there. I like the stock. The problem is the regulatory concerns of them. To me, it's just too much of a concern. Of all the companies out there right now, drug manufacturers are probably, if they're not at the top of the list, they're probably very close to it for concerns when it comes to governments regulating them, and thus having a harder time making money. They were down really big on the week, even though they actually released solid earnings. They kind of issued questionable guidance, which they sold off on. Caterpillar, this is a company that I do have on a watch list. I do like them. I would buy them if they were at a really good price. They're not like a screaming deal to me. They actually missed earnings and revenue. They were down on the news. I think this was kind of a tariff casualty of the tariffs that's hurt them recently. LCII, this is another one I have on a watch list. They just barely beat earnings and revenue. They were up slightly on the week. AMD, which is a company that I just think there's better options out there, but I do watch them because they're a very watched stock. They missed earnings, they beat revenue. Looks like they were actually down quite significantly on the news, but they did make up most of those losses as the week went on. Arista Networks, this is one I really like. They're just way too expensive. They were up even very significantly on their earnings news, just over 15%. They actually beat earnings fairly easily, which obviously is why they're up so much. But I mean, if we look at them, a PE of 54, price to sales of 22. I mean, they're way better than Palantir is, for example, but still just way too expensive. I mean, if we look at their PEG ratio here, I'm going to guess they're around 2.5, 2.78. Yeah, so they're still very expensive. But I mean, look at the margins on this company. Like very, very good numbers here. This is a really, really good company, but they're just way too expensive. They'd probably have to come down 40%, 30-40% before I would be interested. So definitely worth having on a watch list, but just way too expensive. The next one here is QLYS. This is one that I sold recently just because I want to get it at a better price. They actually sold off quite hard on the news of their earnings, which actually weren't that bad, but I think the guidance is what got them there. They're actually trading quite a bit below their historical averages, but honestly, I still think they're a tiny bit expensive, so that's why I'm not buying them where they're at right now. SMCI, this is another one that people watch a lot, a very popular stock out there. Missed earnings and revenue, they were down significantly on the news. CDW, this is another one I have on a watch list, but I think they're a little expensive where they're at right now. They beat earnings and revenue, they were down quite significantly on those news though. McDonald's, another one that I don't know if I ever would buy, but obviously they're a very popular stock. Beat earnings and revenue, they were up on the week. The next one is Shopify. This is another popular one out there. Beat earnings and revenue. They actually had really good earnings. They were up a lot on the week. They're up 22%. So that's insane. They're way too expensive where they're at right now. PE of 82, price to sales 19. Yeah, way too expensive for my liking. I do like them though. I think they're a really good company. They're just too expensive. MetLife, this is one that missed earnings. They were down on the week, I believe. No, actually, they were up on the week. They were down on the news, but up on the week. So I do like them. I think that they're one of the better insurance companies out there. The next one is Paycom Software. They beat earnings quite significantly. They were up actually a lot on the news, but it looks like they gave back most of those gains, but still up on the week. This is another one I do like. I probably would buy them if they were cheap enough. Realty Income. This is a popular one out there amongst dividend investors, but I think there's just better options. Missed FFO, but they did beat revenue. They were up slightly on the week. Constellation Energy. This is another one I would buy if it was a good price, just too expensive. Beat earnings and revenue. They were down on the week though. But if we look at they really only have prices sales here. So I'm not going to speak to how expensive I think they are because I'd have to dig a little bit deeper, which I don't want to do in this video. But I do think they're too expensive where they're at right now. The next one is WMS. They released very good earnings. They were up very significantly on the week. I do like this company. They're just way too expensive where they're at right now, and they're even more expensive after this week. CNQ is the next one here. They're one of the better oil and gas names. I do own them. Very small position, but I do own them. I would pick up more of them if they were trading at a really good discount. They were down a little bit on the week, but they did beat earnings and revenue. Eli Lilly, I follow them just because they're one of the biggest companies in the world. They were down quite significantly on their earnings news. They actually did beat earnings and revenue though. IBP, this is another one I've owned in the past. I don't own them right now. I just think they're a little expensive. They were up very significantly on their news, 18%, beat earnings and revenue. Onto Innovation. This is another one of the more interesting semiconductor names out there. Missed earnings, but they did beat revenue, and they were up very significantly on that news. And the last one here is VCTR. This is one I actually sold recently. I do still like them. I just think they're too expensive where they're at right now. I definitely would buy them if they got cheap enough. They probably wouldn't have to come down even that much. They're very expensive compared to their historical average, but this is a company that probably has like a 1.5 PEG ratio. Let's see here, 1.63. So honestly, they have to come down maybe 10% for me to buy them. So they have to come down to they're at $70 a share, so like 63, the low 60s. I would start to pick them up. I very much do like them. I think they're one of the better companies out there. They're like a small-ish cap name, probably on the smaller end of the mid-cap space. So that is earnings from this past week. There is a few pieces of Bitcoin news that I wanted to talk about. CrowdStrike is a market cap. This is from Punter Jeff, or Jeff Walton on Twitter. Has a market cap of 6 billion greater than MSTR. Recently included in the S&P 500. Below is a visual representation of their historical income priced in Bitcoin. If they were to buy Bitcoin with 100% of their net income in their positive quarters, they'd have 3,757 Bitcoin on the balance sheet. Not doing that has cost them 18,193 Bitcoin. CrowdStrike is down bad in Bitcoin terms, yet launched a portfolio to 60% of Americans. So again, if you look at their earnings priced in Bitcoin, they are getting destroyed. And why is this important? It's important because Bitcoin is going to continue to outperform every other asset on the planet. Maybe not literally, virtually every other, at least of the major assets, it's going to outperform, and that is going to cost a lot of companies money. And it's only a matter of time until companies get sued over this. And this is another thing that not a lot of people are talking about. It may not go anywhere. I could be completely wrong about this, but there's one thing out there that, again, if you're managing a publicly traded company and you leave gains on the table, you can get sued for that. And eventually it's going to get to the point to where the companies that have Bitcoin on the balance sheet are going to benefit from that to such a degree that the companies that don't have Bitcoin are going to get sued, because Bitcoin is going to absolutely destroy other assets, and they're going to get sued because of that, because they're leaving returns on the table. And that's something that not a lot of people are talking about, and it's going to be interesting when that happens, because I think that that's going to be another thing that might literally force every corporation to hold Bitcoin. It might not happen. I could be completely off base here, but I think it's going to happen at some point. JD Vance, soon 100 million Americans will own Bitcoin. He knows what's happening or what's coming. And how this is going to happen, frankly, it's tough to say. I think 401ks are going to, it's going to be normal one day for pension funds, retirement funds, 401ks, all those kind of things to have a percentage, an allocation to Bitcoin, even if it's just 1 or 2%. I think it'll be higher at some point, but obviously it's probably going to start with like 1 or 2%. It's only a matter of time until all of them, until financial advisors, everybody has an allocation to Bitcoin. And when that happens, it's going to benefit the companies, the pension funds, like et cetera, et cetera. It's going to benefit the ones that do it. And what happens when that happens? Well, they're going to get better returns, which means the ones that aren't doing it are going to start doing it. And the ones that are doing it a little bit are going to do it even more. So that's interesting, very interesting. STRC is our iPhone moment. I was thinking about making a dedicated video to this, but I'm kind of busy right now with some other stuff, so I'm just going to bring it up briefly here. But I talked about this last week. STRC is MSTR's new perpetual preferred stock, and this one's different because it is going to be the least volatile in the sense that it has the least duration on it. For those that don't understand bonds and bond investing, the longer the duration of a bond, the more volatile the price of the bond will be. Because if new bonds are issued at a higher rate, nobody is going to want your existing bond. Or they'll want your existing bond, but they're going to pay. They'll only pay a lower price for it, which means the value of your bond will go down, and obviously vice versa. If rates go down, then the value of your bond will go up because people can get a higher rate on your bond they'll get a better return on your bond at a higher rate, so the price will go up. So this is important because STRC has a very low duration, meaning there's very little volatility. And why is this important? This is important because, it should be obvious, but this is important because there's a lot of people out there that are getting very low returns in savings accounts, in CDs, in money market accounts. In Canada, we have GICs, and they're getting very low rates. We're talking like 3-4%. STRC is paying 9%. STRF is paying 10%. And they're not 100% guaranteed in the sense of a GIC or a CD is, but they're as close as you can get to that. It's the equivalent to like a short-term corporate bond. And a investment grade corporate bond, that is, not a junk bond, an investment grade. So the default risk is very, very, very low, and the duration is also very, very low, meaning there's going to be very little price action in the underlying, being STRC. And this is important because who in the right mind is going to keep their money in CDs, in GICs, in money market accounts, in T-bills, when you can get literally more than double the interest rate on an STRC or an STRF. Like 99.9% of the investing world has not figured this out yet, and it's only a matter of time until they do. And this is their iPhone moment, because when people start to figure this out, that is going to be massive amounts of money that MSTR will be able to use to buy Bitcoin, which will only further their gains even more, which will only increase the popularity of MSTR, STRC, etc., even more, which is going to be this never-ending feedback loop of them buying more Bitcoin and the average person getting better returns than your short-term accounts. So again, this is massive. Like, people don't we're going to look back, 10 years at this and be like, this is absolutely insane. MSTR issued a preferred stock that's giving people a guaranteed 9-10% return, and people are still there's still some people that have their money in savings accounts, in CDs, in GICs, in T-bills. Like, people are going to look back at this and be like, this is absolutely insane. Like, absolutely, like, if you have your money in T-bills right now, if you have your money in, again, I can understand, like, your traditional, 3 months, 4 months, 5 months, 6 months, quote-unquote emergency fund. I can understand that, maybe, but who in the right mind is holding traditional bonds when you can buy STRC, STRF, and even STRK and STRD? They're going to be more volatile, but STRC and STRF are going to have very little volatility, and they're giving you a 9-10% guaranteed return. Like, you are absolutely insane to not have a very large amount of money allocated here. Like, again, like, and this is the thing, like, if T-bills were paying 10% or 9% right now, the stock market probably would be down like 20 or 30%. Like, if the Fed came out tomorrow and raised rate, or this weekend or next week, and raised rates to 9% or 10%, like, the stock market would be down probably 30-40%. Like, literally, it would be down 30 or 40%. And this is important because basically, like, something almost as big as that just happened, and yet 99.9% of people are not paying attention. This is another interesting topic here from Romeo Invest on Twitter. What if Saylor is quietly planning to buy struggling Bitcoin treasury companies during the next downturn just to get their Bitcoin? And this is a very interesting point. Like, a lot of people, again, I'm not going to get into the debate on this because I literally have an exact specific video on this. My opinion on, are Bitcoin treasury companies causing a bubble? The short answer to that is no. Number one, because Strategy holds like 2/3 of the Bitcoin treasury companies Bitcoin, and they are not over leveraged at all, quite the opposite actually. And even of the rest of the major ones, they're debatable if any of them are over leveraged. So the long and short of it is no, Bitcoin treasury companies are not causing a bubble in Bitcoin. But this is an interesting topic here because it is absolutely, like, guaranteed to happen at some point. There will be some companies that will over leverage themselves and will get burnt. The thing about this is they're going to be disproportionately very small companies. We're talking companies that own maybe 1,000 Bitcoin. Like, we're probably talking hundreds, maybe 1,000. But we're not talking about companies that are going to own tens of thousands or hundreds of thousands of Bitcoin. Why is this important? This is important because Strategy is buying like thousands of Bitcoin every week already. What difference does it make if some company that has 500 Bitcoin on its balance sheet or 1,000 Bitcoin goes belly up? Strategy's already buying more than that per week anyways. So this is definitely an important point here that nobody that I've seen up until this point has really talked about, but I think it certainly could happen. And the last thing here is Harvard University just bought $120 million worth of the Bitcoin ETF, and this is important for obvious reasons. This is just more institutional adoption, and this is very small. I believe Harvard has like pushing like an $100 billion endowment. So this is like literally like less than 1%. We're talking like 0.1% roughly. It's definitely less than 1%. So I mean, this is a good start. Like, it would not shock me if they say, hey, we're buying 100 million per year in Bitcoin in the Bitcoin ETFs. Like, that more than likely is going to happen at some point. It's not a matter of if, it's a matter of when. They're already doing it. So it's not a matter of if, it's a matter of when. And the real it's not a matter of if, it's a matter of when question is, when does every university start doing this? When does every pension fund start doing this? When does every, financial advisor start recommending it? Like, we're still so early here, it's not even funny. Like, we're still so early, it's not even funny. I think that over the next year, I think we're going to see another major run up. And I didn't really talk about Bitcoin. Bitcoin did pull back significantly, depending on how you define significantly, this past week. I don't think it's important because we've still held the previous all-time high. We went just below 113, at least USD. We're back up to about 116, 117 me making this video. I think that, again, we're just going to see these 20-30% gains. Like, I think the next run up we go up to 130, 140, 150. We come back down to 120, 125, and then we go back up to 180, 170, and then come back down to 140, 150. Like, that over the next 6 months, that's probably what's going to happen. If I had to make a prediction, that's probably what's going to happen, because that's what's happened the last couple times. Right, the last couple times, I mean, 2 times ago, we did have a more significant pullback, but up until this point, we still haven't pulled back past that previous all-time high. So I think that there is 2 very notable numbers. Number 1 is that 112-ish range, and number 2 is that 100,000. If we go below 100,000, unless there's like a 30-40% stock pullback, obviously it's going to come back. But if we go back past 100,000, I certainly will be a little bit concerned. But in the whole scheme of things, no, I still won't be concerned. I'll still be buying the exact same amount, maybe more if anything. So this video is going long enough. This is my longest video in a long time, so I want to leave it there. But like I said at the start of the video, if you got value out of the video, please like, subscribe, comment, check out those links below, and stay tuned for more.